Hey traders, I hope everything is going well. In this video we will be speaking about why people consistently lose money in the market by not understanding the bigger picture and the way the market itself moves. Because the market moves in waves, and here I made this drawing for you in order to put the attention on this topic that most people don't understand. We have here a big monthly candle. Inside this monthly candle we will have 4 weekly candles. Each one of these weekly candles will be made by 5 daily candles, obviously. And here on the monthly time frame you see only one big green candle. Here on the weekly you see 3 green candles but 1 red candle. And here on the daily time frame you will have much more red candles compared to the weekly, and obviously the monthly has 0. So the point is that most people analyze the market only, let's say, on the 1 hour time frame. And on the 1 hour time frame, let's say this even this candle here, okay, let's now take into consideration only the first weekly candle. This candle here on the daily time frame, basically we will have 1 red candle. So inside this weekly candle that it seems only green, this weekly candle itself is made by these 5 daily candles that I have just circled, and inside these 5 candles there is one particular candle, this red one here, that is obviously red. And the point is that people that are analyzing only based on the 1 hour time frame, they will see that for a continued amount of time, so it's obviously 24 hours, the market is just printing lower lows and lower highs. So they will think that the market is actually on a, or even worse, people looking at the 50 minutes time frame and ignoring the higher time frames will think that the market is in a bearish trend. While obviously if you know from higher time frame that the market is supposed to go to the upside, you will know that this is just a small retracement inside of the higher trend. Here, let's keep going. The next candle is another red candle, and inside this rejection candle you will obviously have the next 5 candles. So these 5 candles here will create this candle here. Inside this retracement you will obviously have a big bearish trend on both the 1 hour and 50 minutes, and obviously everything under those time frames, and people will just be ready to short and short. But the truth is that it's pretty obvious that the market is still in an uptrend, and this is just a retracement, possibly to one of the fib levels that you will be easy to identify by taking your fib from the low to the high. I will bring back also the 78.6. So obviously the market is just inside a retracement of the bigger upper move, and it is just a matter of time before the next impulse to the upside begins. Now this is something that people really ignore, because if you understand higher time frame patterns, then you can just use your knowledge of where the market is supposed to go based on higher time frames to wait for this retracement to take place, and after the retracement is over and how you understand that is over, where it's obvious, you will just go down on lower time frames, this time knowing that based on higher time frames you're supposed to be bullish, and you will be ready to wait for a structure break to take your entry. So if you know from higher time frame, let's say from the monthly, you know that you're bouncing off a support level, then on the daily time frame you will wait for this retracements, and on the 4 hours, let's say, because for me most of the time 99% of my entries are taken on the 4 hours, if not 100%. Inside these areas here you will be ready to take your longs, and in this way you will be able to take the long with a really big risk to reward and a higher probability that the market will move in your favor, because you know from the higher time frames that the market is supposed to be bullish. I hope this helped. If it did, post in the comments below, because I will be making more of these educational videos. Hey traders, in this video I will be speaking about the best way to use the Fibonacci tool, and the idea of this video is to show you how is the most accurate way to use the Fibonacci tool. And basically I see many of you that are using the Fibonacci tool in an incorrect way, or if it's not incorrect, at least it is not as accurate as this way. Now let's first start from something obvious that all of you are already doing. The market makes an impulse and the market starts a correction. Once the market starts a correction, you will take your fib from the low to the high, and obviously you will be waiting for one of the fib levels to top. Now obviously when you're searching the best area, the best the fib number that you want to look at, you will be looking for some extra confluence, and this extra confluence will come from a structure area. So if at this particular level you had some structure, then you will be looking, for example, at the 61.8 as your reversal zone, because you have a confluence of a previous resistance now turned support, and you have the 0.618. That is a very strong retracement and is obviously called the golden ratio. Now most of you, when the market will start the next impulse to the upside, you will identify the -27 at this level by taking the fib on this leg. Now this, it is not a mistake, but it's not as accurate as taking this same fib and moving the fib tool to this low, because once the market starts impulsing to the upside, you want to identify your target if you have already longed the pair from this area. So once the market starts the impulse leg to the upside, you will move your fib tool from the low that was, because basically you want information on this leg, you will use the previous leg. If you want information on this leg, you want to take your fib on the previous leg. So you will be taking your fib on the previous leg, and you will identify two zones as your targets, the -27, and if it breaks, this is the -61.8. Now these are the two biggest, the two most accurate targets, because they're taken on the previous leg. So always remember that when the market is impulsing or correcting, anyway you want to take the previous leg. You don't want to just take your fib on this leg and keep it like this. When the market will start impulsing again, this will become the previous leg. So you will move your fib on the previous leg and you will identify the -27, and that will be your first target. So if you're long, that will be your take profit. The same thing if the market is moving to the downside. So if you have an impulse to the downside, you will take your fib from the high to the low and you will identify your numbers. Obviously, as before, if you do have some structure around this area, you will be looking at the 61.8 as your reversal zone. So because in this case you have a support that is turned resistance that is in confluence with the 61.8, so in this case the market will probably reach this level before reversing. But when it will reverse, you will not keep your fib in this way, but you will move it to this high here, and you will identify your two targets. Let's move down to a real-time chart and see if we can find a good example. Okay, here for example we have a good example of exactly what I'm saying. We can use the reply mode, and we will see that if the market is now retracing after this huge impulse to the downside, the market is now retracing. So if we want information on the retracement, we will take our fib on the previous leg from the high to the low. We will see that obviously we do have some support here that is now supposed to be resistance. So the level at which we are looking for the market to reverse is the 50%. So once the market will hit the 50, okay, this was a very strong rejection. Once the market has now started impulsing to the downside, we will move our fib from the low to the new lower high. So we will now identify our first target and our second target, target 1 and target 2. In this way we will see if the market, you see how accurate these levels are, and as you can see that was a very strong zone. So the market rejected it twice, and you can see how accurate your take profit was. also take profit too, in this case hit. I hope this video helped you understand the best way to use the Fibonacci tool, and you can see that this is a very accurate way. It can help you identify the turning points in the market in a very accurate way. If you like the video, make sure you hit the like button and you leave a comment below, because I will be making more free educational videos. Have a good day, and I hope you liked it. Hey traders, in this video I want to show you a trap that many of you are falling into. So keep in mind that this candle here is a weekly candle that happens a lot of times. So many times you will have this kind of shape in a weekly candle, and I know many of you, given that they see this big wick here, they will be thinking that the market has actually rejected higher prices and they are expecting a move to the downside. Now this is very incorrect, because just because the weekly candle has shown some weakness around this area doesn't mean that the market just wants to shift direction. Actually, the higher probability is that in the next weekly candle we will have another push to the upside to basically fill in this wick. The reason for this is that I have shown you here, these are 5 daily candles that will create a weekly candle that looks like this. And as you can see here, we have a very simple impulse correction scenario. And obviously after an impulse and a correction, we are waiting for the next impulse to the upside, not for a move to the downside. And that is the reason why many of you are just looking at only one time frame. Keep in mind that just because you see some rejection here on the weekly time frame does not mean that the market will melt. Actually, the higher probability is that the market has just found some resistance around this area, has made its retracement, and is now ready to go long from a lower price. So many of the big traders will have a better entry before the next impulse to the upside. So make sure you always keep this in mind when you see candles like this. A thing that I don't want you to take out of this lesson is that every time that you see a wick, you will now think that the market is supposed to go long. This is also very incorrect, and there is one thing I want to speak about in particular. If this weekly candle here that opens here and closes here actually does not close here, but it becomes red, so the market basically went all the way upside, all the way here to the upside, and then closed back below here, so we will have a red body inside this area here. In that case, everything obviously changes, because here in the daily time frame we will not have the close here, but we will have another red candle that is basically closing. Basically this candle here will be closing below the open here, and if this happens, obviously the market, this retracement, failed to respect all the fibs, so the market closed back below also the 78.6, that is the last relevant fib. So obviously the next impulse to the upside is very unlikely to happen, and in this case we're actually looking for bearish movement. So keep in mind that the candle must close green. Everything that I have just said holds true also for a bearish candle. So if this candle is basically reversed, so we have the wick to the downside, and here obviously the impulse will be to the downside, is exactly the same scenario. So also for red candles that have this shape, obviously the wick will be down here. The same concept holds, because also on the daily time frame you will have a scenario of an impulse to the downside and a correction. So what we're expecting next, the next impulse to the downside. Let me know in the comments below if you have any doubts about it, and I will clear them out. And let me know if you liked the video, and if you did, make sure you drop a like for more free education.